So my name is Jim Strang and I'm the chairman of HgCapital Trust. HgCapital Trust is a private equity investment trust that invests in software and tech-enabled business services companies based in Europe and in North America. In terms of the current positioning of HgCapital Trust, it's very much consistent with what it's been doing over the last several years. So the business targets specific sectors and specific subsectors within those areas for its investment strategy. So at the moment we target 8 clusters around the software and tech-enabled business services space. And the common denominator across those different subsectors is they're all very resilient in their nature. So the services that these subsectors provide, if you like, are non-discretionary items that businesses use to improve the efficiency of their operations, and that's what we've been doing for a very long time, and we haven't changed an iota in the last reporting period. So in terms of recent performance, HgCapital Trust is announcing its interim results, so the first 6 months of the year, and I would say the way I would characterize those results is they're very resilient. So what we've seen really is in a world where the transaction activity, certainly new investment activity, has slowed down because of the environment that we're operating in, our portfolio has actually performed incredibly well. So the assets that sit within our company, so there are around about 50 different underlying investments, as a group are doing very well. And the top 20, which is what we typically use to frame our aggregate performance, is still showing very strong growth. So the top 20 is growing at both its sales and its profitability at around about 30% on a LTM, last 12-month basis. And in terms of its profitability, it's running a north of a 30% EBITDA margin or profitability margin. So our core portfolio is actually proving to be incredibly resilient, and it's a testament to the businesses which are themselves enablers of better business performance. And so actually, despite challenging economic environment, our companies are doing incredibly well. So we're very pleased to be able to talk to that. And as I said, the new deal activity has slowed because of the environment being more challenging for new deals. However, we have been able to generate significant liquidity. So we're very pleased to report the amount of liquidity that we've managed to create over the period, which has come from selling different businesses that were already within the portfolio. So when you add that all together, you basically see that the net asset value of the company for the first 6 months has gone up by just under 5%, and the share price over the same period has gone up by just over 7%. So these are, I think, solid results without being in any way spectacular, but I think the heartening thing is the quality of the portfolio underlying, which is evidenced by the way it's performing. So in terms of activity and holdings specifically, we only have one new investment in the period, which is a business called HgTreasury, which sits within the Mercury Fund, which is the smallest of the 3 fund families that we have in the portfolio. And this is, again, everything we do rhymes, and this is no exception. So this is a business which sits in the software makeup in what's called the Office of the CFO, and investors and potential investors will know this is something we've done quite a bit of in the past. And so this particular business is very much in line with a previous set of experiences we've had and previous investments that we've made. And the idea of the business very broadly is it plugs into the CFO function in a corporate and improves the efficiency of treasury operations, which, as you can imagine, in the world that we have with the interest rates moving around all over the place, is actually quite an important thing to get right. So that's a very obvious and clear example of an investment that fits the structure of what we do, and indeed just repeats the model that we've used in the past. And then on the flip side, maybe a little bit more color on some of the exit activity. So we sold a business called Transporium, which was, again, a software business which was used to help businesses that managed fleets of equipment manage those fleets of equipment more effectively, improve the yield management of those businesses. And that was a successful exit. And as we have certainly a history of doing, we exited that business above where we valued it at. So in the case of Transporium, it's around about 20% above the value. And in this reporting period, we actually got the money back. And it's 100% cash. So it's all cash back at that increased valuation. And then in addition, post-balance sheet, we've actually had 3 more exits. We've had Team System, Comify, and Assets. We're very happy to see the sort of cycle, the machinery operating, and actually, despite the challenges of the market, the HG and the manager are able to exit these assets again above where we've marked them, which I think is testament to their skill and actually the quality of the businesses that we've got in the portfolio. So in terms of outlook going forward, I think we are really heartened by our portfolio performance, which is proving to be very resilient, as I noted, and particularly the ability of the portfolio to be resilient to rising prices. So the price pressure that you would expect from such an inflationary environment has actually been well managed by these businesses, for the most part, because they are themselves price-setting businesses. They have the ability to manage the inflationary effects at their own level, as opposed to being taken or subject to the challenges of input cost inflation. So that's a very good news. And we see no reason to believe that story won't keep going. I think on the new deal activity, there's sort of cautious signs that things are beginning to unlock a little bit. If you looked at our rolling expectations over the year as it's passed, they have definitely improved. And you're beginning to see some signs of that in the capital markets and the stock market. So we feel like the machinery is going to sort of increase its speed over the second half of the year. We don't know to what extent, but we feel like it's going to be more than the first half. And that should see more investments, again, all consistent with our archetype and our strategy. Nothing's going to vary there, but more things will likely happen in the cycle. And again, as our underlying portfolio will continue to build value and hopefully compound up in the way that it's been doing in the past. So that's our sort of very pragmatic, but cautiously optimistic around what we think the second half will hold. Well, thank you very much for taking the time to listen to this presentation. And indeed, if you have any more interest in the company or anything around what we do, then please go to our website, click on the link, and you should find all the information that you require available and there for your perusal.